the title of this piece makes a promise. And the honest thing to do before anything else is to examine that promise with the same clarity that anyone serious about money should bring to any financial claim they encounter. Turning $100 into $1,000 sounds straightforward when it is condensed into a headline. It sounds like something that can be achieved with the right information, the right method, the right sequence of steps applied over a reasonable period of time. And in the most technical sense, it is achievable. The mathematics of it are not complicated. The path from 100 to 1,000 is not mysterious, and there are people who have traveled it. But the distance between those facts and the impression the title creates, the impression that a simple strategy exists, which makes this journey reliable, repeatable, and accessible to anyone who learns it, is enormous. And that distance is where most people lose not just the original $100, but whatever they add to the account in pursuit of a goal that was never as simple as the framing suggested. So this is going to be an honest piece, not a deflating one, not a lecture about why ambition is dangerous or why small investors should stay away from markets. An honest one, which means building the complete picture of what turning $100 into 1,000 actually requires. What the realistic time frames and risk profiles look like at different approaches, what the specific strategies that give this journey the best probability of success actually involve in practice, and what the behavioral and psychological realities are that determine whether any strategy produces its theoretical results or gets undermined by the same patterns that undermine most retail participants, regardless of how good their starting plan was. Honesty about all of these things is not the enemy of ambition. It is the foundation that makes ambition survivable. The first thing to understand is what a tenfold return actually means in the context of investment and trading mathematics. $100 becoming $1,000 represents a 900% gain on the initial capital. To put that in perspective, the stock market in developed economies has historically produced average annual returns in the range of 9 to 10%. At 10% annually, turning $100 into $1,000 takes approximately 24 years through compounding. That timeline is the baseline. The result produced by doing nothing more sophisticated than holding a broad market index fund and allowing compounding to work. Any strategy that promises to achieve this same tenfold return in a significantly shorter time frame is implicitly promising returns that exceed the market's historical average by a substantial margin, and the relationship between return and risk in financial markets is not optional. Higher targeted returns require accepting higher risk, which means accepting a meaningfully higher probability that the capital is lost rather than multiplied. This is not an argument against trying. It is the starting point for understanding what trying actually involves, because the strategies that can realistically produce tenfold returns over short periods, active trading, options, concentrated positions in volatile assets, are the same strategies that can and frequently do produce total capital loss. The strategies that reliably protect capital and produce positive returns over time, diversified index investing, quality stock ownership, fixed income allocation, produce those tenfold returns on timescales that feel long relative to most people's patience. The choice between these two categories is not a choice between a smart approach and a naive one. It is a choice about time horizon, risk tolerance, and what role this particular $100 plays in the broader financial picture. $100 that represents genuinely disposable capital, money whose loss would not affect daily life, emergency reserves, or other financial commitments, can justifiably be deployed in higher-risk approaches, with the understanding that losing it entirely is a possible outcome that has been accepted in advance. $100 that represents a meaningful portion of available savings, or that is borrowed, or that carries any pressure to produce returns, because other financial needs depend on it. That $100 has no business being in high-risk strategies, regardless of how compelling the tenfold return sounds. With that foundation established, the strategies worth examining are the ones that give a small starting capital the best combination of realistic return potential and survivability. The ability to still have capital to work with after the inevitable losing periods that every approach produces. The starting point for all of them is the same principle that governs all sound financial activity at any capital level. The preservation of capital is the prerequisite for its growth, and any strategy that risks the entire capital base on any single outcome is not a strategy for growth, it is a bet, and bets have a specific mathematical structure that is tilted against the bettor in most cases. The most realistic path from $100 to $1,000. For someone starting with genuine financial education and genuine commitment to the process is through the stock market, using a systematic approach that combines consistent contribution with disciplined stock selection or index investing, over a time horizon that allows compounding to do the heavy lifting. This path is not exciting. It does not produce dramatic week-to-week results that create compelling narratives. It does not generate the kind of story that gets shared on social media or discussed at social gatherings. What it produces is a reliable, mathematically sound accumulation of wealth that has a high probability of reaching the target if the investor stays with it long enough and contributes consistently enough, starting with $100 and adding even modest regular contributions. $50 a month, $100 a month, whatever is genuinely affordable without creating financial strain, changes the mathematics of the journey dramatically. The tenfold return on the original $100 becomes increasingly less dependent on market performance and increasingly driven by the simple act of adding capital consistently over time. For someone who wants to pursue the journey primarily through investment returns rather than additional contributions, the most important structural decision is the one that determines how the $100 is allocated and how much of it is at risk at any given time. Putting the entire $100 into a single stock, a single option position, or a single volatile asset is not a strategy. It is a coin flip with worse odds than a coin, because the coin has a 50% chance of coming up in your favor, and the market is under no obligation to provide even that. Allocating the $100 across a diversified set of positions, either through a low-cost index fund that provides instant diversification across hundreds or thousands of companies, or through 3 to 5 individual stocks, selected based on quality criteria and purchased in roughly equal allocations, reduces the dependency on any single outcome and gives the portfolio multiple paths through which growth can come. The practical reality of working with $100 in a brokerage account is that commission structures and minimum investment requirements have changed dramatically in recent years, making small account investing far more accessible than it was a decade ago. Most major brokerages now offer commission-free trading on stocks and ETFs, fractional share purchasing, that allows partial ownership of high-priced stocks for any dollar amount, and no account minimums for basic investing accounts. This means that the mechanical barriers to starting with $100 are genuinely low, and the primary limitations are not logistical, but strategic and behavioral. The choice of brokerage matters. A platform with commission-free trading, fractional shares, and a clean interface that doesn't encourage excessive trading through gamification features is meaningfully better for a small account than one that charges per transaction fees that consume a significant percentage of each trade's value on a $100 account. The index fund approach for $100 looks like this in practice. The entire $100, or as close to it as the platform's minimum purchase allows, goes into a single broad market index ETF, something that tracks the total stock market of a developed economy or a major index representing a broad cross-section of that economy. No stock picking, no timing, no analysis of individual companies. The money sits there, reinvesting any dividends automatically, gaining or losing value in proportion to what the underlying index gains or loses, and growing over time at whatever rate the broad market produces. Regular additions, whenever affordable, go into the same fund. The review schedule is quarterly at most. Not daily, not weekly, not every time a news headline suggests something significant is happening in the market. The approach is boring by design, And the boredom is a feature rather than a bug, because the trading activity that boredom motivates is the primary enemy of compounding returns at any account size. The individual stock approach for $100 requires more work and more discipline, and it introduces more variability in outcomes, both upside and downside, than the index approach. The principles are the same ones that govern quality investing at any capital level. The businesses being considered for purchase have durable competitive advantages that are clearly understandable. Without specialized industry knowledge, consistent histories of generating returns on capital that exceed their cost of capital, management teams whose track records and capital allocation decisions inspire genuine confidence rather than requiring faith, and financial structures that are conservative enough to survive periods of economic stress without threatening the business's viability. The price paid for each of these businesses reflects a margin of safety, a meaningful discount to a conservative estimate of intrinsic value that provides a buffer against errors in the analysis and against developments in the business that weren't fully anticipated. And the position in each business is sized as a roughly equal proportion of the portfolio rather than concentrated in a single name based on conviction. With a $100 account, 3 to 5 individual stock positions represents the minimum meaningful diversification. 3 positions of roughly $30 each. 5 positions of roughly $20 each. The fractional share capability that most modern brokerages offer makes this possible regardless of the absolute price of the individual stocks being considered. A company whose shares trade at $500 per share can be owned in a fraction equivalent to $20 of exposure, which means that stock price is no longer a constraint on diversification for small accounts in the way it was when fractional shares weren't available. The active trading approach, using short-term price movements to generate returns faster than long-term investing allows, is the one that the title most directly evokes when it promises a simple strategy for turning 100 into 1,000, and it deserves the most careful and honest examination, precisely because it is the most appealing and the most dangerous. Active trading on a $100 account faces structural challenges that make it particularly difficult to execute successfully, even for traders who are competent at the analytical side of the process. The first challenge is that the dollar amount of any individual trade, with proper position sizing at 1 to 2% risk per trade, is $1 to $2. A single losing trade at proper risk management costs $1 to $2. A single winning trade at a 2 to 1 reward to risk ratio produces $2 to $4. Building from 100 to 1,000 through these individual trades requires a very large number of them, each executed correctly, over a period that makes the time investment questionable relative to the capital being compounded. The mathematics of active trading on small accounts improves substantially as the account grows. A $10,000 account with 1% risk per trade has 10 times more capital at work per trade than a $100 account, making the absolute returns on winning trades far more meaningful. This creates an argument that is counterintuitive but mathematically sound. The most effective use of a $100 trading account is often not to trade it actively for returns, but to treat it as a tuition account, a practice environment, where the skills of market analysis, trade execution, risk management, and behavioral discipline are developed at a cost that doesn't threaten financial stability. A $100 account that teaches the discipline of consistent stop-loss implementation, the practice of position sizing from a formula rather than from intuition, the experience of sitting through a losing streak without abandoning the strategy, and the development of a trading journal habit. That account has generated value that goes far beyond whatever its dollar return happens to be over the period. The skills developed on a $100 account transfer directly to a larger account when more capital is available. And the losses incurred during the learning process cost $100 rather than $10,000. For the trader who is genuinely committed to pursuing the tenfold return through active markets, the strategy that gives the best combination of return potential and capital preservation on a small account is one built around very selective trade entry, maximum discipline on position sizing and stop placement, and a patient approach to finding setups rather than forcing activity. Specifically, waiting for market conditions that strongly favor the strategy being used, taking only the clearest and highest quality setups, rather than every marginal opportunity that vaguely resembles them, sizing each position so that the maximum loss, if the stop is hit, represents 1 to 2% of the account, placing stops as hard orders before the position is entered, and reviewing every closed trade in a written journal that captures the reasoning, the execution quality, and the emotional state at the time of the decision. This is not a dramatic or exciting description of a trading approach. It is an accurate one, and the gap between this description and the descriptions that typically accompany promises of turning 100 into 1,000 in the financial education industry is itself instructive about how those promises are built. The options market is frequently presented as the vehicle through which small accounts achieve dramatic returns, and it deserves a direct and honest discussion. Options do provide leverage, the ability to control a larger position than the capital invested would allow in direct stock ownership. And that leverage does create the mathematical possibility of very large returns on small initial investments. $100 in options can, under the right circumstances, produce returns that would require thousands of dollars to generate in direct stock ownership. This is true. What is equally true, and significantly less prominently featured in options education aimed at retail participants, is that the leverage that creates large return potential also creates large loss potential. That options have a time dimension that direct stock ownership does not have, which consistently works against buyers of options, unless the price moves in the expected direction within a defined time frame, and that the probability of any individual options trade producing the kind of dramatic return that makes the instrument so appealing is substantially lower than the probability of the option expiring worthless and the entire premium being lost. Buying out of the money options, the cheapest options, the ones that are most frequently presented as lottery tickets to large gains on small capital, requires the underlying asset to move significantly in the expected direction within the option's lifespan for the trade to be profitable. The probability of that happening on any given trade is low. The time decay that erodes the option's value every day, regardless of what the underlying does, works continuously against the buyer, and the implied volatility that was priced into the option at purchase often decreases after the event that was supposed to drive the move, further reducing the option's value even if the underlying moved in the right direction. Options are not a simple strategy for turning small accounts into large ones. They are a sophisticated instrument whose mechanics work against buyers in ways that are not intuitive until they have been experienced through actual losses, and using them without understanding those mechanics thoroughly is not a strategy. It is expensive education. The cryptocurrency market, which presents itself as another accessible vehicle for dramatic returns on small initial capital, has a similar structural profile. The history of cryptocurrency markets contains examples of returns that exceed even the most optimistic stock market projections. Assets that increased by multiples of 10, 50, 100 in relatively short periods. It also contains examples, in far greater number, of assets that declined by 90% or more from peak valuations, of projects that turned out to be fraudulent, or simply failed to develop the utility that justified their valuations, and of retail participants who entered the market during periods of high enthusiasm and exited during crashes, having lost most of what they invested. The volatility that creates the possibility of large gains in cryptocurrency also creates the possibility of large losses. And the market infrastructure, the regulatory environment, the information availability, the market manipulation concerns, is less developed than in traditional equity markets, in ways that create additional risks for retail participants without the resources to navigate them. $100 in cryptocurrency, treated as genuinely disposable capital, whose loss is acceptable, deployed in a diversified way across assets with genuine use cases and development activity, rather than concentrated in speculative projects, and held with the patience that long-term investing requires, rather than actively traded in response to price movements. This is a speculative, but not irrational use of a small amount of capital for someone who understands what they are doing and why. $100 in cryptocurrency. Treated as the beginning of a get-rich-quick approach, leveraged through derivatives, concentrated in the highest volatility assets, based on social media momentum, and traded actively without risk management. This is the path through which the $100 disappears, and the lesson about financial markets is learned in the most expensive possible way. The honest framework for turning $100 into 1,000, stated plainly, without the simplicity that the title promises, but with the accuracy that the topic requires, looks like this. The fastest path carries the highest risk of losing the entire $100 and requires skills that take time to develop. Active trading or options, done correctly, with rigorous risk management, disciplined execution, and a realistic understanding that the journey is more likely to take years than months, even when done well. The most reliable path takes the longest time, but carries the lowest probability of losing the entire investment. Systematic index investing with regular contributions, compounding at market rates, potentially supplemented by selective individual stock position in quality businesses purchased with a margin of safety. The middle path, selective active investing in individual stocks with longer holding periods than active trading, but more concentrated positions than pure index investing, offers a balance of return potential and risk that suits investors who are willing to do the analytical work, but who recognize that short-term trading is not where their advantage lies. What turns any of these paths from a theoretical framework into an actual outcome is the behavioral dimension, the consistency of execution across the full range of market conditions and emotional states that the journey from 100 to 1,000 will produce. The market will, during any meaningful period of participation, create conditions that test every aspect of the investor's or trader's behavioral discipline. Winning periods that create overconfidence and the temptation to take more risk than the strategy defines. Losing periods that create discouragement and the temptation to abandon the approach in favor of something that feels more likely to work. Volatile markets that create urgency and the feeling that action is required when inaction is actually the correct response. Slow markets that create boredom and the temptation toward activity that generates costs without generating returns. The investor who has a clearly defined approach, who understands the reasoning behind every component of it, who has defined in advance what conditions would constitute a legitimate reason to change it versus what emotional states would produce the impulse to change it without legitimate cause. That investor has a realistic path to the destination. The investor who is following a strategy they read about without deeply understanding it, who has no framework for evaluating whether what they are experiencing is normal strategy variance or genuine strategy failure, who makes adjustments based on recent performance rather than principled analysis. That investor is on a different journey, one that is likely to end significantly short of the destination, regardless of which strategy they are nominally following. The $100, wherever it goes, is not primarily a financial investment. It is an investment in understanding, in building the practical, experiential knowledge of how markets work, how risk feels in real time, how behavioral patterns emerge under financial pressure, and how disciplined execution differs from intended execution when the emotional reality of live markets arrives. That understanding, built carefully and honestly on whatever capital can be genuinely afforded for the purpose, is worth far more than the returns it generates in the short term. Because understanding built on $100 transfers to $1,000, and $1,000 to $10,000, and $10,000 to whatever the actual investable capital eventually becomes. The strategy that turns 100 into 1,000 is not a trading system or a market insight or a specific allocation formula. It is the consistent, patient, disciplined application of sound financial principles across whatever time and market conditions the journey requires. With full acceptance that the journey takes as long as it takes costs as much as it costs in learning along the way, and produces its results not through any single brilliant decision, but through the accumulated effect of many ordinary decisions made correctly and repeatedly over time.